Welcome back to another episode of Investing Explained. Here's today's question.
Hi, Preston Stig. Thank you for the excellent podcast and keep up the great work. My question is around a conversation you had on your previous podcast on options, where you highlighted that it's worth understanding the cost of these options and whether it's worth, for example, putting in a normal stop on a stock position rather than actually buying a put, which could be very expensive, in particular if it's very volatile. I wanted to understand, how is it possible to price these options? Because I understand it is quite complex and there are a number of factors involved. And also, where can one find the resources and tools online in order to price these options so that you can ascertain whether it's worth buying an option if you wanted to have exposure on the downside, but also on the upside when you want to do leaps, for example? Thank you.
Mario, I absolutely love that question. I think that there is a strong misperception of how options work and how they're priced. So I'd really like to go through, like an example. It's going to be a few numbers, so please stay with me. Perhaps you need to go back and re-listen to the example, but I think it's very important for people to understand some of the math behind options. Let me give you an example with the price of Berkshire Hathaway. And in this example, I just assume that the price of Berkshire Hathaway is $180. The first term we need to clarify is what is a premium? And a premium is just a fancy word for the price of an option. So what does it cost to buy? And now in this example, we're just talking about a call option, so we hope for the price of the underlying stock to go up. And now we also need to clarify what is a strike price. So a strike price is the right to buy something at a given price. So let's take the example of Berkshire Hathaway, and as mentioned before, it's trading at $180. If you had a call option that gives you the right to buy one share of Berkshire Hathaway for $150, say a year from now or 2 years from now, that $150, that is your strike price. Now, we also need to have a third term. I know it becomes a little complicated now, but as I mentioned before, this is just to give you some of the math, some of the intuition behind a call option. If the strike price is $150, if it gives you the right to buy that, it's what we call the intrinsic value of a stock. Now, please don't be confused. I know we talked a lot about intrinsic value, which we call like the true value of a stock. But when we talk about options, that basically just means that you can exercise that option now and you can get X dollars out of it. And so in this situation, if one share is $180 and there's a strike price of $150, you have what's called intrinsic value of the option to be $30. That's money you are more or less guaranteed with today's price. Now, the value of an option is also determined by what is referred to as extrinsic value. So the extrinsic value, that's your potential upside. Remember, you don't have to exercise the option today. That's the entire point. If you buy an option today, you have the option or the opportunity to exercise that later. And that's very, very important to understand. Then you have something like volatility that includes into pricing of an option. So if we think that Berkshire Hathaway is very volatile, it's actually not. But if you think it's very volatile, that premium of Berkshire Hathaway would go up, like the price would go up, because you don't care if you buy a one share of Berkshire Hathaway, if you just buy the call option, if the price goes down to $100 or $50. Because remember, you are guaranteed money as soon as it's worth more than $150 for one share of Berkshire Hathaway. And the last thing, please stay with me guys, the last thing that's also determined by is the time for expiration. Because the longer you have to wait for, say, the underlying value of Berkshire Hathaway to go up, the longer you have, the more lucrative is that option. Because you can just sit and wait for good things to happen, for the market to go in your direction or whatnot. So let's just have a practical example of an option of Berkshire Hathaway today. If you bought that at a strike price of $150, an expiration date 21st of January 2022, the premium would be $50. So let's talk about why does that make sense? Well, the stock is trading $180, so we already know that you have $30 in intrinsic value. So the extra $20 in premium that comes from the optionality that Berkshire Hathaway appreciates in price from more than $180, and it would do that before the 21st of January 2022. Now, let me give you another example. You could also have bought a call option out of the money with a strike price of $300. The premium for that would only be 65 cents. That's because it's highly unlikely that Berkshire Hathaway would trade at more than $300 before January 2022. And even if it did, it would likely not trade a lot higher than $300. Say, for instance, that the stock would be trading at $310 at the time, which in that case means that you can only take a $10 profit. So to make money in options, you have to have a different opinion than the market. So whenever Preston or I talk about potentially oil price could go to $50, $100, and for us to buy an option on that, you have to understand that the money it takes to make that bet is very, very different than the potential outcome. Now, it has to correspond, but it's not like, oh, I would much rather have an option with a strike price of $150 because that's more likely than $300. That's obviously priced into the market one way or the other. Do I think that 65 cents is a good price? I would say that there are good arguments why it would be a fair price. But if it was trading at $10, there's no way I would touch it. But was it trading at 1 cent? You bet I would buy all the options I could get my hands on.
I think the main thing people can take away from Stig's comment, especially if you've never dealt with options, is this is something that you typically have to get your hands dirty with in order to kind of understand how they work. If you're just reading about the theory of it and you've never actually stepped into the market and actually purchased a call option, it's not really going to sink in. You're not going to understand that when you're buying out of the money call options that they're very illiquid. And if you want to sell that position, you're going to pretty much take a shellacking as you offload it. Like those kind of things you don't understand until you've taken the shellacking. And so this is something that I want to tell people that I think is really important. Most of how I deal with options, I have taken straight out of Joel Greenblatt's book, You Can Be a Stock Market Genius. That book, I think, lays out some really sound ground rules, especially for people that might be doing this for the first time. One of the most important pieces of the ground rules that he talks about is whatever principal you have in your portfolio, it should not make up more than 10% at most of your portfolio if you're doing options. I think that's a very safe rule to have. And some in the industry would look at 10% as being extremely high. So I would preface that. I live by that rule. The other thing that he talks about is he only does long call options in leaps. And so I've adopted the exact same rule. I only buy call options. I don't participate in the derivatives market. And I'm sure a lot of people might be rolling their eyes and saying, oh, well, that's ridiculous. You're leaving a lot of opportunities on the table. But for me, it works. I know that whenever I buy that long call, 2-year call, I have time for the position to be right. And I also am in a position where my downside is limited to the amount that I put into it. So if I put $1,000 into that position, I can lose that entire $1,000 position if I hold it to maturity and the price does not go above it, the strike price on the call. But I'm fine with that. That's just how I personally do it. And I know there's many arguments why I could do more with my options strategy, but that's just how I do it. One note on the premium part of it. So when an option is priced using Black-Scholes model, that's the model that if you took a derivatives class in an MBA program or something like that, you're going to do these Black-Scholes models and you're going to come up with a valuation for these options. And it's going to come out to be whatever strike price for whatever security and for whatever duration. One of the main factors in this is the expectation for future volatility. So if you're dealing with a security that doesn't have a lot of volatility, the price for that option is going to be greatly impacted by that volatility. If the volatility expectation or the past performance of the volatility has been very wide, that also is going to be based into the price because when you think about the potential for the price going to the upside or the downside with a lot of volatility, that has to be built into the equation. And so you're going to pay a lot more for something with a lot of volatility. So when you talk about a premium for an option, the way I think about it is the market is anticipating that underlying security going in a certain direction. And so they're paying a price above the Black-Scholes amount that you're calculating. So like, let's say if we did Black-Scholes, that the option should be priced at $2 per option, but the market is currently trading it at $3 per option. You could say that there's a $1 premium being placed on that option above the Black-Scholes price because the market's anticipating that the trend of the underlying security is going to be going above the volatility range that is being calculated based on past performance. Because when you're doing Black-Scholes, you're basing that volatility on past performance. Black-Scholes, you can read a ton of it. We can put some links in the show notes to provide you the equation for Black-Scholes and all the variables and how it's calculated if you want to learn some more. This stuff gets pretty complicated. Like, you know, if I was going to say one of the hardest classes I took whenever I was getting my MBA was a derivatives class, I found it quite challenging to do a lot of the math and to think through, am I long, am I short, is it a put, is it a call? All that kind of stuff gets pretty complicated. But I would tell you, if you really do want to do this stuff, definitely start out with very small position sizes. If you get your hands dirty, it's going to help you out a ton to just kind of understand the nuances of it. Because when you lose money on a position, let me tell you, there's no greater education you could possibly receive than by taking a loss or a hard lesson by buying things that are way out in the money and you don't have liquidity when you want to change your mind and things like that.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.